Good morning, students. I'm Akansha Arora, Assistant Professor, Department of Commerce in Xavier's College, Jaipur. The topic of my today's class is accounting concepts and conventions. Before we proceed with the meaning of accounting concepts, let us just take a minute to revise what is accounting all about. Accounting is generally referred as a language of the business. Why it is being referred as a language of business? That is, whenever businessman wants to know how much profit is earned or how much loss has been suffered, we quantify in terms of accounting. Accounting is an art of recording, then it is classifying in the books of ledger, then we summarize in the following three statements, that is trial balance, trading in P&L account and balance sheet. Then after the summarizing is done, it is analysis, interpretation, and finally communicating the results to the users. We know that we have the end users and various parties who are interested in the accounting information. So the very first concept of today's class is accounting concept. Accounting concepts are the assumptions on the basis of which the financial statements are prepared. Then accounting conventions, these are referred as an unwritten laws. Why are they being referred as unwritten laws? Because these are those customs and usage for recording the accounting information. These are the list of the accounting concepts. To begin up, we'll start with going concern concept. Going concern concept is an accounting principle which states that accounting will continue forever. Whenever the business we have started with, the business has been started with, so it is not being thought that we're going to dissolve the business in the near future, and we have assumed that the business will continue for the foreseeable future and will not be liquidated in near future. So on the basis of this, the accounting is being presented and properly being presented in front of the users, as the business will continue for indefinite period of time. Then is business entity concept, which defines that business entity and the owner are two separate entities. All the transactions pertaining to the business would be recorded in the business books. And whereas the personal transactions of an owner would be recorded in a separate books being prepared by the owner at his end. That is why whenever an owner presents or invests any amount, it is being written under capital as a liability, because it is a liability of a business to give back the amount to the owner, whereas all the personal expenses of an owner are recorded as a drawings. Next is money measurement concept. So we only record those transactions which are measured in terms of money. The financial transactions are only recorded, that is the quantitative transactions. We usually ignore qualitative transactions such as loyalty, efficiency, and management labor relationships, because these cannot be measured in terms of financial data. So we only record such transactions which are financial in nature or quantitative in nature. The common denominator that we use for recording the transaction is rupees. So we're going to continue the other concepts in the next class. Thank you.